Thanks everyone for joining. Basically, I am not recommending buying or selling or follow exactly what I'm saying. So what I'm going to be doing today is I'm going to share some of the things I've learned over time from ICT. And I am going to try to give you enough information that you can read price action on your own. Some of you already experienced, you already know what you're doing. Some of you will agree and some will disagree with my approach, and that's fine. There's no one way of doing it. So the first thing I want to point out that ICT's channels on YouTube. I started back in late 2022 when ICT started doing his mentorships, and I've gone through all of his playlists. The playlist that I would highly recommend is the 2022 mentorship. You can start with video 2, and you can go for at least video about 12 or 13. The rest of it is him doing basically applying it on charts and showing you how do you look at price action and how do you look for bias. The other really key playlists are the month 4. This is where he goes through all of his PD arrays and what to expect from each and how do you take a trade based on that. Actually, the trading usually is, I believe trading is in month 5. So those two, month 4, month 5, I think those are must watch, regardless of what type of setup you do. Now, in 2024 and 2025 ICT mentorship, he used to basically teach fair value gaps, and then his private mentorships, he focused on order blocks. And in 2024, 2025, he wanted to teach how do you do price analysis and setup based on one time frame. If you go back to the basics, you'll get more out of it. So I would focus on those. Definitely month 4, month 5 at a minimum. And personally, I love 2022 mentorship. This is what started the public ICT mentorship. 2023 has a lot of advanced stuff. And I started to lose my setups when I went through 2023 because there was so much content in there. I started modifying my setups based on that content, and I ended up losing track of my original setups, and I had to spend some time going back to them. So let's take a look at price action. One thing to really understand is that price is fractal. You don't have to abide by the standard time frames, 1 minute, 5 minutes, 15 minutes, and it does not have to start at the beginning of a specific minute. So you can treat it however you want. Some of my time frames that I have 45 minutes time frame, I have 88 minutes. And some of those 88 minutes, I found it in a book. But if you notice here, candles do not, at the bottom, candles do not start at exact minute. It just doesn't matter. Time is fractal. Don't get hung up about, it's a 15 minutes, it's a 1 hour, it's this, it's that. You can make it whatever it is, whatever adds clarity for you, just go with that. And you can apply what's called candle math. For example, I can look at this candle pattern here. So price, for example, opened here, and over those candles right there, it opened there, draw a box for it. It went down, came back, and based on this up candle, it closed there. Okay, this color. Okay. It went up over there, and it went down to the bottom over there. That's a valid candle, even though you don't see it there. It just started there. It went up, came down all the way back, then it came back and closed there for those candles. That's very valid. You don't have to go by anything specific. You can just do what works for you. It's important for you to understand that time's fractal. You don't have to abide by something specific. Just do what works for you. Okay. So let's talk about how price moves. In general, when you're looking at price will make higher highs, higher lows. It will sometimes do something like this, come back up and go up. We need to understand where are the turning points, and when it's pulling back, where is it going to? Usually what happens if you look at any segment of price, and again, I'm at a random time frame. When price goes up, every candle you understand this one. It'll go down, go up, and close. I've seen a lot of content online where they tell you it's going to consolidate, it's going to drop, it's going to go higher. Personally, I haven't seen that to be true. I haven't had success evaluating candles based on that because sometimes it'll just go up, come down, then come back up. It'll do different things. So I don't put too much weight on it. I wait for a candle close, and instead of trying to understand what all this price is doing and what's going to do next, what I do is I go to a higher time frame. I go to 4 hour, try to see what's going on. If this is not clear for me, I have 8, I have 16, I have a day. So I'll go until I see exactly what's going on. For example, here, price action on NQ. I pointed out a while back that the price is going to go up to, at the time, it was going up into the order block. And I said, we'll have to look at the time, that wick. And what was it doing at that wick? You look at these things, you're not trying to know exactly or nail exactly what is it trying to do. It gives you reference points, what price is going to do, the behavior of price, and so forth. Right now on weekly, and that's okay. So when price moves up, it's going to be very efficient. And what I mean by that, for every move higher, it has to rebalance it back. It doesn't have to do it right away. So sometimes it comes down, up, then we'll rebalance it and then go higher. So prices do that often. You need to understand that and figure out where exactly it's going to turn next. So when you're looking at a candle, it's going to open, come up, and go higher. The usual tips, is it going to keep going higher or not, is that you look at the previous candle. So if you close above previous candle, usually that's a sign of strength. So you see here it closed above, this one did not. If it did not close above it, you expect it to consolidate. Doesn't always, not 100%. It depends on other things. What gives it credence is just PD arrays such as order blocks, fair value gaps, and so forth. But you can start basing it on that. The minute you start seeing strong moves higher, it's going to basically give you some kind of a pullback sometimes. And it's going to pull back towards certain levels. For example, it's going to pull back towards a rebalance, immediate rebalance, which most of the time they rebalance. For example, this one closed much higher than this one. So you have that gap right there from here to here, where price only went up. So this one came down, rebalanced it, and then came back up. This one, same thing. It closed way above this candle right here. This one attempted to come back. It did not reach it. It left a fair value gap. So now you're seeing there's a fair value gap. Price went up, rebalance. Now you look at this one, rebalance. Yes, it's going to rebalance, but there are fair value gaps below it, 2 fair value gaps here. So you expect price may come back to that level. So every time there's a gap in price, you expect it to come back and rebalance it. It doesn't have to be immediately. It can come in, it can run all the way up, and then like it did here, it ran all the way up and then came back and rebalanced this one here. Obviously, it's not going to rebalance everything. You'll see some things down here. The stock market is not going to crash 90%, but that kind of just gives you a reference point around expectation. So every time price closes above the third candle back, so this is 1, 2, the third candle back, if it closes above the high of it, you expect some kind of reaction. So price is going to do one of 3 things. It's going to close inside the range. It's going to close above the range and then come back and touch it, or it's going to leave a gap. So when you're doing analysis like NQ on the monthly, we can see we're pulling up. We have a rebalanced situation here. So some point is going to take the high, and sometime next few months, it may come back and fill this gap. It doesn't have to fill the whole fair value gap. It can fill partials, but there's an expectation that at some point there will be a pullback towards that level right here. And I don't like this color. Okay. So it's going to come back and fill this fair value gap. And that's how you do your analysis. So when you base it on closed candles, I can look at daily and see what did the previous day do. It failed to close above it. Okay, it's going to consolidate. Oh, close below it. Okay, it's going to go lower. But you look at other things as well. Do we have any fair value gaps? It's going to pull lower towards what? It's going to pull lower towards an inefficiency, some kind of a gap. And you look left and try to see where are the gaps and what's trying to fill and so forth. Now, in multi-time frame analysis, or when you look at multi-time frames, every gap higher, so what is it doing? It's rebalancing. For example, let's start from here. It's rebalancing every move down. It's trying to rebalance it, or it's going to leave a fair value gap. You keep an eye on it. Then it left another fair gap here and there. What's going to do is going to come back up and rebalance it. It came down. It left some fair value gaps below. And now this is one leg coming down. So it came down. What's going to do is in the move up, it will move up doing one, it will rebalance the previous leg, any fair value gaps in the previous area. And it's going to come back and rebalance everything as it moves higher. And again, doesn't have to do it right away, but eventually it's going to come back and rebalance them. At the same time, all of this move down, think of it as one candle. So if you consider this one as one candle coming down, this move higher needs to rebalance this one. So every move higher, this one did not rebalance yet, but you expect at some point this one is going to get rebalanced. This one moved higher. This is a high. Come back and rebalanced it. This one moved away from that level. It came back and rebalanced it. So every high low is going to come back and rebalance it. It's not coming back because it's going to necessarily fill a fair value gap, but the fact that between this level, and you can say this level as well, that's a fair value gap. Between this level and when it left here, that's a fair value gap. And the reason for that is that, like we said, time is fractal. At some point, at some level, those become a high and a low of a fair value gap. So you can keep going up, for example, 3 months and so forth. So you will find something there that eventually is a fair value gap and is going to come back and rebalance it. So again, time is fractal. It's not basically a one-time thing. Highs and lows in ICT are PD arrays. So when you see a high drops and go above it, there's an expectation it may come back and retest it. If it doesn't, it will do it later. Retest it and went below. We were talking about this one earlier. So that one came down and closed it. And going higher is going to come back at some point and retest this one here. That happens to be an order block. Okay. So you always have that expectation that price will balance either per candle, per each side of the candle, or based on bigger move higher. You can even look at all of this. It came back and rebalance that. You can look at this one. It's going to come back and rebalance. It's too low, so I don't think this will come back and rebalance this one because that would be a crash. So you can say, for example, this fair value gap is not going to rebalance, and you can actually do a measured move from here and see how far higher it's going to go. So you can predict that. Okay. Let me switch colors and let's do green and red. Okay. By the way, I use white and black. It's just something I've learned before, that red candle psychologically may trigger me thinking it's negative and cause some kind of a reaction because, oh, look, it's crashing type thing, versus it's just a candle down. Okay, so that's how price will always balance. So if it goes above, this one did not close above it, so you'll expect some kind of consolidation. On lower time frame, most likely this consolidated and then closed above. Next candle came back, rebalanced it. Then went higher. Next candle came back, attempted to rebalance it. It did not. Went higher, left a fair value gap. At some point, it's going to come back and fill that, most likely. And this whole move is trying to rebalance all of that. This whole move rebalance this one, and so forth. You look at this one. You look at next week. If this week closed higher, you expect it to come back and then move higher. What if it doesn't? Then it doesn't. You're having expectation when the day open is going to do certain things. Now, the other PD array. So we talked about immediate rebalance, the highs and lows, basically to always come back. If it's coming down, it's going to do the same thing. Highs and lows going to get rebalanced up and down. So that gives you some kind of the wave approach keeps going up and down. And what is it doing right there? Do I take an entry right there? No, it worked here. It didn't here. It just gives you an expectation of what might come in next. To know where it's going to retrace, you drop to lower time frames. Now, that's the high and low PD arrays. Let's talk really quick about fair value gaps. Some of the misconceptions is that if there's a fair value gap, that means it's a bouncing spot where we can take an entry in that direction. And that's not true. All what a fair value gap tells you is that there's a gap in price where price was delivered in one direction and is going to come back and rebalance it. It can rebalance it and keep going through it. That's the rebalance. It can come back and basically balance the price range and drop. How you can use it is that if you're going long, and let's say today, if you're going long and you see a reversal, for example, you're expecting a reversal, and of course, we don't have great price action, but basically, let's say this is a breakout structure. We're expecting a reversal. You can look for a fair value gap. One, okay, I can take an entry here. You have a reversal. Okay, where's the fair value gap? It's right there. Came back to it. So if you think it's going to go higher, it gives you some kind of a clue of where you may want to take your entry at. Usually what it also tells you is that if it fails, for example, this left a fair value gap, it retested it, came down and went through it. That's a failed fair value gap. It failed to support price higher. It rebalanced it and kept going through it. That you invert it and becomes an inverted fair value gap, and now you expect to support price higher. So usually what I do, I look for failed fair value gaps, not because it's an I fair value gap, it's just because it tells me price did not respect it and it moved higher. If you have something like here where you have two of them, this is small, but just for reference, this one basically, it did not respect it. If there's another one above it, then I ignore this one because it may go to the next one and still go down. I'm looking for that higher one or the singular one. So I would have paid attention to this one here versus that one. It doesn't mean I wouldn't take a trade on this one, but I'll have an expectation it's not going to go through that just because it closed above this one. It may want to retest the higher one. So you always have that expectation. It may want to rebalance the higher one. Either a low is rebalancing it or a high is rebalancing it. So you look at some of those closes, you put them together, and that gives you some kind of an indication of what is it trying to do. Fair value gaps, it's not that every fair value gap is tradable or reversible. It just means it's an imbalance that needs to be balanced out, and then it may continue or reverse. You use that with combination of other things to build a case of where it's going to go next. Now, if there's no fair value gap and price is reversing, then you expect it to take the low. So if this one reverses down and you think now this is going to go lower, there is no fair value gap. So most likely it's going to go and take the low. ICT always says price goes towards liquidity or fair value gap, which means it's going to go rebalance an imbalance such as fair value gap or volume imbalance, or it's going to take the low or high. So that kind of also gives you a clue around what it may do. If it's a small move, also again, it may be going to a lower time frame fair value gap. For example, if this is going to drop, it may go to this one here. So we start looking at those clues around where it may go to next. So that's basically, in a nutshell, how you look at fair value gaps. Other important PD arrays are order blocks. And there are variations of it. So when an order block fails, it becomes either a mitigation block or a breaker block. And they're both the same. Both of them are a failed order block, except mitigation means it failed to go higher, it dropped, so it's weaker than a breaker block because, for example, this is a breaker block right here. came up, come back, and went below it, it's going to retest it, go lower. Whereas this one, see, this is a mitigation, for example, block. It came up, dropped, it came back and went through it. And the reason, because it's still within the range. That's why it's a mitigation. It's a little bit weaker. It's within the range. We don't know if it's going to continue or not. You look at some other clues around what is it doing, and you go from there. So in general, every down in a move higher, every down candle is an order block. There are other things to say. If it's above 50% of a range, I would stop treating it as an order block. For example, if I'm looking at from this move up to here, those up candles, I can treat them as an order block, but I wouldn't treat this one as an order block coming down because it's already in discount. There may not be enough room for it to go. So you look at where they are. There are some criteria for high probability order blocks. If it has a fair value gap behind it, it's great if it's not retested. For example, this one, it broke above, it came back, went above, it came back, then went through it. I don't treat that as a high probability order block. It just may not hold, it goes through it. It's going to go to something that's usually not tested multiple times, something that price moved sharply away from. For example, this order block here. Retested it, I don't like that much, but that's okay, and went right through it. So you want to see that. So you want to see a strong move away from a price, come back to it, and then go higher. It's going higher. Every down candle, you can take the high, the open, and the middle of the body. But for the sake of this one, you look at every those candles are going to support the price higher. This one here, because this one did not hold, so expect it to support price higher. So whenever you have down candle followed by a move higher, you expect it to hold. If it doesn't have much room, you have some kind of a noise over here like that, you expect some kind of a retest is going to go lower. It may not hold. It just gives it low probability. And look at that. We have a fair value gap right below it. That even makes it less relevant because of being part of a fair value gap, price is going to rebalance. So we start combining them that way. Now, same token, for example, going higher, up candles when price go below them, that becomes a order block. You look for the low or high coming up, the middle of the open and the middle. If a big wick, then you can take the half the wick. You don't just look at, for example, bearish order block in this case moved lower. You also look at every failed order block to form some kind of resistance. This one became a breaker block. Give it a red. This one, we looked at this one, it became a breaker block. It came back tested a few times. It didn't reach these. It went higher. This order block now becomes a resistance. This candle here will become resistance whenever retested. So you start looking at every candle becomes inverted. So you always look left to see what's going on. Did we have a failed fair value gap? Yes, it rebalanced it. It will act as an invert and becomes resistance from the other side. And same thing with all other candles. And that's really the key for market maker buy and sell models. When you see them, there's usually a base where it's price consolidate and then move higher, comes down, moves higher, comes down, and then at the peak, and then basically fails and start going lower. When it's going lower, it's coming back to those down candles, as well as rebalance that move, comes down, rebalance that move, looks for an order block or a breaker block, and then comes back down to the base. So either it's going to go below it or it can reverse. You don't have to expect it to always sweep the low. So that kind of gives you kind of some clues around what price is trying to do when it starts showing you what is it doing. So now, how do you know price is going to reverse versus price is going to go through something? The simplest form is to use multi-time frame. And if you look at the order block video from month 4 from core content, around 16, 17 minute mark, ICT mentioned a multi-time frame analysis type thing in passing. It was a quick example, but that's really the basis for a lot of the content you see out there for fractal models and all that. So, for example, right here, how do I know this fair value gap is going to hold or not? You don't. Let me go to a higher time frame than 1 minute. Let's go to, let's say, 1 hour. We have a lot of consolidation. Those are really terrible price action. But let's take this one. You have a strong move higher and a fair value gap happen to be right behind it. Where do I take an entry in here? You don't take an entry here. You use the higher time frame to base your entry on a lower time frame. So what I would do in here, I would drop to lower time frames. You can look at 15 minutes, see what is it doing. 15 minutes comes here. Look at that. We have a down candle moved higher. That can give you some kind of a clue. There's a fair value gap right here. It may still want to come down to it within 15 minutes. And even if you're looking for 1 hour, you can also look at this one here based on 15 minutes. So you keep dropping down, trying to see what's the price action is trying to do on 5 minutes. It's right there. I can use the 15 minutes because it's lower than the 5 minutes. That helps me refine it, for example. Higher time frame, 15 minutes, is more important than a lower time frame. I don't know if it's going to stop at the wick, half the wick, or the open, but in this case, for example, went to the open. So that validates that. You also have fair value gap right here before the move. So you start refining your entries like that. And what that tells you, okay, this might be done. How do I confirm it? You look at now here. Did it close above it? That's an order block because that's the lowest down candles before the move higher. I don't like this wick. It can go down to the middle of the wick. You start looking at these things, but you want half that body to hold the price, to hold the candles. You don't want the candles to close below the half of it. It's a sign of weakness. This tells me it may consolidate. So you start making account for that. See right there. You start accounting for that, but that tells you now this is possible reversal. So you base it on a higher time frame and you refine it on a lower time frame by looking at if price on 1 hour needs to move lower. Let's just look at 1 hour and 4 hour. So when I'm looking at this, when it's coming down on 5 minutes, and I can see on the 1 hour, there is a imbalance, volume imbalance. It always comes back and it tests. I love those are really strong levels, but it went through it, tested the fair value gap and started bouncing higher. So that tells me it may move higher. Where is it going to go? What level? What's there? If it goes through this one, where is it going to go next? So it may come back and reach the lower half before it bounces. It may come back. There's a fair value gap. An order block is going to be somewhere in that range where it might bounce back higher. And 5 minutes, you can even drop it to 1 minute and look at it and see what it's doing. It swept liquidity. It went back to that level. It rebalanced an old high, and then it took those highs. Okay, so it came back. Where it's going to come back to a certain level and move higher. So you start looking at multi-time frame that way. It moved higher than the previous hour. I still have time, but basically, if it closes higher, it's going to come back to a level and move higher and so forth. So you start looking at multi-time frame analysis and trying to see what is it going to do next? There's a rebalance level. This is an important level, not because of the 5 minutes, but because of the 1 hour. I don't see much on the 4 hour here, but I don't know what's left because we only display certain things. We have an order block level key here on the 4 hour. So if it comes down, my eyes automatically will go to the lower time frame. Those are important. Is it going to go below this one? Yes, there's a possibility it's going to sweep this low if it comes down, but I don't expect it to go for that low because you have a big order block in here and go higher. So you start doing a multi-time frame analysis that way. You look at what is it doing per level and refine it at a lower level. And you always base it on a close candle. So this candle is live. It's not as important for me as the one before it. because you don't know, it may wick up and then come down, close lower, and so forth. But you're basing on, is there a setup based on the previous candle? So you're always looking at that. You're looking at prices to support something in one direction. If it reverses above it, then you expect it to act as a resistance from the other level. You want to see something that showing signs of resistance. For example, let's talk about my fair value gap, inverse fair value gap. You want to see an inverse fair value gap, for example, and of course, price action right now is not that great. Let's see. You want to see one that was retested. So for example, this one is a stronger inverse fair value gap because price tested it, rejected it, and then went through it. Once gone through it, then tested go versus one time pass, just another field. Like for example, this is another one. It retested it a few times. It went through it, it failed, come back here, lower one. It retested it multiple times. Once it goes through it, it becomes a resistance. It's going to bounce, and then hopefully eventually goes. So you want something that was tested multiple times versus it was not really tested much and just went through it. Just not going to act as a resistance, just going to go through it. Not always. Again, it's just a probability games. So if you see something that price went through it, it inverted. This one went up through it and came back through it. The next one took it. So you start looking at them that way. It didn't hold as an I fair value gap. On the upside, it did. So you start looking at those things, which is what makes it higher probability. What's on the left? If I'm looking at this one going up, I don't know if there's something on the left. I may go up to a higher time frame and see where it's going. So price right now, which is this line, is going to go higher. It's about to hit an order block coming up. So what is it going to do here? There's no other fair value gaps above that. So once it crosses that, it's going to take the high. You start looking at price action that way. And if you don't see something on 4 hour, you look on the 1 hour and you start dropping in time frames to see maybe it's trying to rebalance something on 15 minutes. So you start looking something like that, walking down the chain until you find a level that makes sense. There are some tips and things you start getting used to. For example, when I'm trading, I like the 15 minutes personally. And again, it's a preference. You get comfortable with certain levels. I was talking to someone today. I don't want to mention names just in case he doesn't want to be mentioned, but he trades 30 minutes and 3 minutes, and he looks at certain criteria. I focus on 15 minutes and 1 minute. But personally, I like to see a trade in the direction of the 15 minutes. If it's coming down, I want to see 15 minutes support, basically, more so than anything else. 15 minutes is a good time frame to look at. But you also look at session and what are the sessions are doing. And again, it's different between Forex, crypto, and stock. I only trade futures, so I cannot talk about the other ones. But usually there are times of the day where price is going to reverse. Usually 8:30, you're going to expect some kind of a move. You look at a low on 15 minutes and a high on 15 minutes. That's probably what the first thing is going to go. Usually it will it didn't do it today, but usually it'll take the low and then takes the high around 8:30 to 9:30. Based on NQ stats, he expects the low or high of the day between 9 and 10. That's usually where he sees the low or high of the day, or making a turning point between 9 and 10, and the next one between 2 and 3. He calls it the noon curve. It's on his website, and he has a YouTube channel for it. So he looks for those. This is going to be the one side, this is the other side. Sometimes it happens right before, sometimes right after, but you expect a reaction around those times. And he has a channel. It's the NQ stats, and look for the noon curve right there. So he'll talk about how he runs statistics basically, and he found those are the spots to make a reversal. So usually if I take a reversal in here, I have a little bit higher confidence coming out of 10 o'clock that is going to move higher, because that looked like the low for me and it needs to move higher. Why the low? London is higher than Asia. It came back and retested it. It's making basically higher highs. It's going to go higher. You also, and again, today's price action is horrible, but at 8:30, always expect a Judah swing where price is going to do something and then reverse, do something, then reverse, do something, then reverse. So you'll see that a lot, those Judah swings. He covers that in his 2022 mentorship. So we look at those and we try to trade based on some of that. I look for a reversal around those times, somewhere between 8:30 and 9, 10 o'clock. I don't like to hold through the 9:30 because I don't know what the price is going to do. If I do, I only need to look for left. Where is it going to go to? There's nothing left. This is basically swept the low, so I know this low is going to hold. So when it came down, my stop loss was here. I think was here. No, I took this trade right here. My stop was here and then went up. So you look at those type of clues around the time of day because price action overnight is a little bit different than price action during the day. You get a bigger range, both on 1 hour and higher. You may get consolidation because of the lack of people involved, lack of volume for prices and things like that. You start looking at things in that perspective. You start looking at, if you look at 1 minute and it's not clear, I don't know what it's going to do, go up to the 15 minutes. Does it provide any kind of clarity? It does not. Okay, let me go up to 1 hour. At some point, you're going to find a level that you look at as, okay, now that makes sense because now it went above here. There's a fair value gap, order block coming back up. It may come down here and then go higher. So it starts giving you some kind of clarity around what's going to happen next. This consolidation that happened here, it's because of these candles right here. So it consolidated, it hit it a few times, then went higher. You go to the 5 minutes today over here, price got stuck between two things. You have this fair value gap going lower and this fair value gap going higher. I was watching these. I was like, okay, it needs to break somewhere and then break to the high and then came back. You start realizing it's doing something. It needs to break one way or another. Is it going to go lower or higher? Most likely higher because the day is bullish and because London is higher than Asia. And it's just, you start getting a feel for it. But you also look for confirmations. Big, strong move down. It moved higher than that. That's an order block and a mitigation block. This is the green candle is a mitigation candle. Moved higher, came back and rebalanced it, order block, mitigation block, fair value gap, pushing the price higher. You start paying attention to those things. You also want to pay attention towards what's happening on higher time frame. For example, let's say, see where is that? Somewhere around here. Let's say we're here. Okay. If I'm here and I see this one and I think, you know what, there is a bearish order block. I'm sorry, it's that one. Let's assume we don't have all this big move here, or let's say this order block right here, and you see a bearish order block. See right here, and you think it's gonna hold, and I'm gonna go lower. You look at the higher time frame, either indicator, I have a free one, or if you have multi-screen, for example, I have multiple screens. And let me pull. This is another one of my other monitors where I have NQ and ES. I can watch all of them. I don't use this computer. I'm using it just for this presentation. I trade on my iPad using my indicator, but I can watch higher time frames. I have the 1 hour, that's 1 hour, 4 hour, 1 day, 1 week. And what I'm looking for, not just a setup, I'm looking to see, is there anything in the way? Is this going to be a reversal? For example, after a strong move higher, is going to come back here. This fair value gap, there's volume imbalance. Nothing here to tell me I want to go lower. So I look at higher time frames to support the narrative as well. It may not, but I'd rather be on the safe side than not. I probably want to see this one, for example, failing, which it's a breaker plus an order block. It goes below, it's going to hit it, go lower. I'd rather see that than just trusting this one here because of the price action here, because it may come down here. It's going to go lower. No, there's an order block. It's going to hit the order block. I don't trust it, even though it may pass that order block right there. Okay, it failed. If you look at, for example, fractal model, you have a failed one. You expect it's going to hit, for example, and again, I'm just using it as an example. It's going to go to a CISD. It's going to go lower. My eye right away goes to what's in the way. 15 minutes, 1 hour, 1 day. If there's something that tells me it has a up narrative, trend is going to go up and it's coming to retest versus it's a reversal. So I need to make sure on a higher time frame, there's nothing in the way, because the higher time frame always wins. And when you play it out, you start noticing, okay, it tested it, but what did it do? Bounced off the fair value gap and now it's going up. Is it going to go lower? It's still not a case for it to go lower. So you start looking at these things and you want to have some kind of assurance around what the price action is going to do next. Your job is not just to find a setup. Your job is to avoid a loss. And you're going to do that looking at multi-time frame analysis. Use them to know what your narrative, use them to know if there is something in the way. You start basing your analysis based on that. You'll start developing some patterns. For example, like when I see some price action, when it goes down and goes higher, you expect it to go higher. Goes down, goes higher, expect it to go higher. Sideways, I don't have bias. It may go either way. So you start looking at that type of reaction is going down, it's going higher. I know ICT talks about trend lines and all stuff. It's really the same thing. I disagree with him in that because it's a trend reversal. It went through it, come back up. He looks at it, retail expecting it to go lower. No, retail looking for a breakthrough. We have 5 minutes. So the other item I want to cover real quick is that I see a lot of people looking for indicators to do something, to tell them where the price is going, where it's going to balance, and so forth. The thing you need to understand is price is fractal. So when you look at something like this, and this is daily, I don't care where you draw a line. I can do a line right there. I can do a line right there. I can do a horizontal line. I'm just drawing line through price action. If you drop to lower time frame, they all will work. There is no good or bad time. If you look at any of them, for example, if we look at that time frame right here, let's make it a little bit, okay. If you zoom in, price came, crossed, tested it, went up, came back, tested it, went down, came back, resistance, came back, tested it, went up through it. Same thing. It will respect it every time. Same thing with the other blue line. It come back, retesting it, is doing the same thing. Look at this one. How many times it came back and tested. And this is just a random line I just drew. So it doesn't matter where you draw the line. If you're looking at those indicators that showing you lines and where price is going, ignore that. Focus on the candles. Candles will tell you the story. Random lines on the chart assumes price is going to do exactly the same thing it did last Monday or the average of Mondays or whatever it is. It doesn't really matter. What they help with is that they give you a reference point. For example, simple moving average. I can draw a moving average, and a lot of retailers use it. They use the 20, for example, or the 50 or whatever. Let's give it a sharp color. Okay. It doesn't really matter. I can give it a random number. I want to use 117. Okay. Price coming back to it, reacting to it, because it's an average. It's an average. It's going to cross it. That's the average of a price. So when you hear what's the perfect level, what's the perfect moving average? 29. Okay. It doesn't really matter. Price will respect all of them. However, if you use it consistently, you'll have success rate because you're working probabilities. More than 50%, you're a winner. You combine it with something else, it will give you some probabilities. So all of that doesn't really matter. Don't focus on the indicator. ICTs, for example, first presented fair value gap. Let me show you one. You see any fair value gap here you want to draw your attention to. And you can pick a random one. Let's take this one right here. Okay. And I am going to extend it to the right. Okay. Or I want to take this one right here. pick any random one. You find one, there's one right there. Let's highlight it. Go to the right. Respecting it, went through it, came back to it. Went through it, came back to it, and down. Came down to it, came down. It's all relative. It's all based on the price action being efficient. You just need a reference point. You want to pick the first fair value gap after 9:30, great. That's a reference point. As long as you use the same one every time, you're going to be good. What's the difference between this one and that one? I don't know. You drop it there. Now, price didn't get there enough, I guess. Not yet, but tested it multiple times. What if I want to move it to just any other random point? It's that one right there. It's doing the same thing. So price is fractal and price is efficient. And every point on a chart is going to be referenced multiple times, regardless of time frame you're using and direction you're using. And you can draw any random line on a chart and price will react to it. So if you're looking for how far away is it going? Okay, there. It's okay. It's touched it. What about there? Resistance type thing. They all work. I like ADR, which is average daily range, because it's like an average. Or you can use, for example, the standard deviation, the official standard deviation, where it tells you, for example, if a price reach 1, there's 61% chance of it reaching level 1. There's, I don't know the exact number, let's say 5% or 6% level reaching 2. So you expect some kind of reaction there versus I know it's going to go there. So you start building things like that. The other one is ICT calls standard deviation. It's really a measured move, which is taking a swing high to low. I see a lot of indicators now doing this, which is fine. It's a reference point, and you look for 2, 2.5, and 4 or stuff. That's fine. That's a measured move from low to high. It's called standard measured move, and it goes usually in traditional TA is going to go to 1, it's going to go to 2, it's going to go to 3, and so forth. So if you take it even over here, it's okay, that standard measured move is going to go to 1, then you're going to look for 2, and so forth. Does it always do it? No, that's expectation. So there are some standards because people got used to them. There's an idea that if it breaks above a pivot point, it's going to go higher. I like to look at, I have that, things like that, which is break above, lower high, tells me it's going to go higher. Higher low, failed here. So you start looking at certain things and going up time frames, because time frames will tell you what the story is going to happen. So we're right at time.